So S&P, homing in on S&P, how to efficiently play a year-end rally in stocks. So if that's what you're looking for, a year-end rally in stocks, as I am, but it just seems to be taking a bit longer to materialize, how would we go about playing it? So the S&P has been carving out this correction for a while now. We were hoping that was the low, wasn't meant to be. We had a little bounce and now we've gone lower again. So whenever this bottom kind of materializes, whether it's in now or whether it happens middle of October, we do think then the year-end rally can actually take hold. It might have already started. It might start in a couple of weeks, right? So that's kind of the timing I'm working on right now. Now, I think it's unlikely that the S&P or the SPY is going to breach this downtrend resistance, which is this red line. By November expiry, this comes in about between 430 and 435. So even if we do get a rally out of this market, we think you're going to struggle to breach that resistance in the first rally. Probably going to hit that level, retrace a bit, and then go and have your proper year-end rally. So what we're thinking is we can utilize middle of November calls and sell those, provided we don't breach this area, and then use the premium to kind of cheapen up the cost of some year-end calls. So we can sell November 17th calls and we can own 29th of December calls to play that year-end rally, but basically cheapen up the cost. That's the idea. Now, the market nerves around the Middle East conflict are also something that's keeping a bit of a lid on the market. That might start to wane after a couple of weeks as the market just gets used to that. Same thing with the Russia-Ukraine war, right? The market was scared of it in terms of risk assets, and then it's been lingering now for nearly 2 years. So markets get used to that. They price it in, and then they focus on the next macro driver, which is more likely to be other things like rates or what's going on in rates, basically. Okay, so that's where we are. That's what we're looking at. The dashboard on S&P shows us that S&P vol is elevated. Spot is relatively low in its range. Skew has flattened out a bit, sort of mid-range. But really the key here is the term structure. So the term structure is quite flat. You can see that here. That is pretty flat for the S&P. Typically, we're going to be in more of an upward sloping curve when the S&P is rallying. Okay, so the way you take advantage of that flat term structure is you sell shorter dated options and you buy slightly longer dated options. So that's the trade we're looking at. The carry's positive as well still, which means you don't want to be buying loads of outright options. You don't want to be piling into Vega when Vega's near the sort of top of its recent range and when it's not carrying itself, i.e. the spot's just not moving enough. Okay, so these are things that push us towards what we call a call calendar spread. The call calendar that we like